Welcome everyone. Thank you for joining this session after the brilliant keynote that we had this morning. I can promise you a lot of things, but no talk about AI or LLM here, for better or worse, so you know what to expect. This is a business value track session where we're going to be talking about how a few key metrics are used at Rebtel to steer our business strategy. Before we get into the main of the work today, just 2 words by myself. My name is Quentin. I'm originally from France, but I've been living in Sweden for the past 5 years. And I currently work as a data engineer for a company called Rebtel. Now, on the side note, if you want to get my attention during the rest of the event, talk to me about anything triathlon related, and you know I will be fully engaged with you for the rest of the day. The way we're going to talk about this today, so it's kind of a two-parter where the first part is we're going to define and try to look at the metrics that we are using. And the second side is more on the tech side, kind of how we are calculating them, and some pointers for you as well if you want to get going with that. Now, before we actually start with the definition, maybe 2 words about Rebtel as a business. So for those of you who don't know us, we are a cross-border tech company that cares for migrant workers. So if you go live abroad and you want to stay connected with your folks at home, then we are basically trying to be a one-stop shop where we offer different services to stay connected. So it can be international calls or money transfer, mobile top-ups, or things like that. When we think about our business and when we consider how people transact with us, we typically look at it in 2 ways. So either people can do one-off transactions, so maybe they're going to send 10 gigabytes of data to their mom that are still in the home country, and this product can be used until it runs out. Or we also look at it from a subscription-based point of view, where people can send every month 10 gigabytes to be used. When we talk about subscription model, something that jumps at you in terms of a metric is retention, right? And now retention can mean different things from different parts of the business. If you're talking about behavioral analytics, maybe it's about how long are people staying in the funnel, like where are users dropping off in the journey, or how many days in a row people are coming to your app. For us, when we talk about retention, we are looking at, based on the first transaction date that you've had, for how many months are you coming back to use the product. And this is typically how it looks like when you're trying to plot it. So here what we are seeing is that when you talk about retention, in the first few months, you're going to have this big dropout for people that transacted initially on a given month and then didn't come back. And then you have this flattening out for people that are pretty loyal to the product and the offering that you have. When you're capable of kind of plotting this over time, you can really see and target this as your North Star and try to improve it based on how you want to develop your product. And if we are comparing 2 cohorts over basically a 1-year period, so for people that joined in July last year, how many of them transacted in August? The churn rate that we had was about 70%. So only 30% of the users were actually coming back on the second month to continue transacting with us. And if we compare this with the same cohort, so the same kind of market a year later, what we can see is that with all the emphasis that we have put in to try to retain users, we have a retention rate of 50% within the first kind of from July to August, right? Which is a pretty great improvement compared to what we are compared to our business strategy that we set up. It's pretty important to get this measure right, because if you're not calculating it correctly, then the way that you are going to try to strategize your business and your product development might be incorrect. So, for example, if you are overestimating your retention, then you might think that you can spend a lot of money in marketing to try to acquire more people. But what's happening is that all of these users are actually not sticking with you. And so you're actually not making a profit based on all the users that you're getting, because people are leaving anyway, right? So depending on what you see in retention, you can really decide kind of, is it better to grow your product in terms of retention and try to add more features to keep people engaged? Or do you want to attract more people and get more people to use your product in the first place? The second metric we're going to look at is lifetime value. I think that's also another pretty common one. So when you check online about how you can define LTV, what you typically see is that you have the average margin per user. Sometimes you look at it from a revenue perspective. That really depends on your business. And then you multiply this by churn rate. And as an example, what you can see here is that if we have, on average, a churn rate of 1% per month, then the theory is that if it's linear, after 100 months, everybody will have churn, and no one is still remaining in your cohort. When we started thinking about this measure, this is not something that we found very actionable, right? Like when you're trying to define your business strategy within the coming year, it doesn't really make sense to look at it, how much money you're going to make over 10 years. Like in 10 years, product is going to be very different, right? So we weren't really happy with the way that this could go on forever. And instead, when we are talking about LTV, what's happening behind that is that we are actually looking at a cap version of LTV, where we are trying to look at the total margin that we are having over the first year. And so the way that we calculate this is very simply where we sum all the margin for the first year, and then we divide that by the count of the initial people that transacted at the beginning of the cohort, right? And what that gives you, or like what you might think when you look at this, is that we're actually not taking churn or retention into account here, right? So you were not like in the previous version of this. But when you actually calculate the sum of the margin or revenue over the first year, then the retention is really implicitly taken into account, because obviously the margin is going to be lower if you lose people within the first year. Again, this measure is pretty important in the same way that retention was, right? So if you're getting this measure correctly, then you can send it to your commercial team, and maybe they will try to define a better pricing plan. So if you think that a certain cohort has an LTV that you're not really happy about, then maybe it's time to look at the pricing or the cost that you're having, trying to increase this margin to get people to have a better kind of return on investment for a particular cohort. On the marketing side, when you compare this LTV to the acquisition cost that we're going to go over in just a moment, this is really insightful to say where you think it's better to spend your marketing money, right? You're going to want to spend your marketing money in a cohort that is more profitable over 1 year than one that is not as profitable. A third metric that we also consider here is also, I guess, pretty standard. It is the acquisition cost. And here, for us, it's basically all the marketing spend that we are having in our social media platform or in our search ads up until this first key event, which is the first transaction that a user is making with us. Now, all of these metrics are pretty good, but they can be pretty dangerous if you look at them in silos, because if you look at them in silos, you might give a direction for your business that is actually maybe not what you're trying to achieve for. So if we look at a typical acquisition cost of $20, so for each user, it takes $20 on average to get them to their first transaction. If you try to compare this with retention on 2 different cohorts, you might think, okay, so the second cohort has actually a retention of 20% within the first year, and so actually it's maybe interesting to invest more money in this second cohort. But when you try to add another metric, which is LTV, then maybe you realize the first cohort is actually more profitable overall within the first year, maybe because these people in the first cohort, even though they don't stay as long, they maybe transact more, or the pricing that you have is more aggressive, or things like that, right? So the bottom line here is that all these metrics are very important, and you must calculate them correctly, but they really bring more value to your business if you can put them together and if you can look at them in a aggregated way. And having said all of this, we're also looking at some compound metrics that are actually putting this together just so we have more context in this. The first one that we are looking at is payback time. And so for us, this is a measure of time that we typically calculate in months. And it's the time that it takes based on the LTV that we have, to offset this initial acquisition cost. So to put it into like a formula here for everyone to understand. So what we take is that we have on one side all the upfront cost that we have, which is the acquisition cost, and we typically also throw in the welcome offer. So this is very much akin to what you have for streaming platforms, where you have maybe the first month for free, right? But you still have to pay the cost of the product that we have. So this is kind of included in the upfront cost that we have to pay to get people to use our product. And then LTV we already have. So if we are trying to look at one example here, and we say that we have initial upfront acquisition cost of $25, and then we assume that our total LTV for the first year is going to be $50, then what that leaves us with is a payback time of 6 months, right? So if we assume linearity, then within the first 6 months, what we are saying is that we will have offset this acquisition cost, and then we will be making a net profit based on everyone in this cohort. When you're able to calculate this for all the different cohorts that you're looking at and you're trying to plot that over time, it's really a key metric that we are using to take different actions for how we want to operate in certain cohorts. And what we are going to do here is just look at a couple of examples. So if we're looking at cohort number 3, what we are seeing here is that within the first 2 years, we are still not profitable. We are still not making a profit compared to this initial cost. And so rather than trying to spend more money trying to acquire more people in this cohort, you're basically wasting your money if you are not sure that you can ever make a profit on this. Another action that you could take is instead look at your unit economics. So maybe the cost is too high that you're paying to your provider, or maybe the pricing is too low and you're not having this margin effect that you're looking for. Now, for us as a business, our product value is pretty small, so playing with margin is typically pretty tricky. So another thing that you can play with is the acquisition cost, right? We saw the example where you have $20 to acquire a new user, but maybe that's also something that you could play around to kind of lower this value and decrease the payback time. Now, on another cohort, on a different example, if you're already pretty happy with the payback time that you have, so in this case, let's say that we have offset time of 11 months, so less than a year, and you're pretty happy with what you have, then instead of being more aggressive in the way that you price your product, maybe a better solution or better direction is to actually try to grow your user base, right? So you know that within the first year you're going to have a profit, so maybe you spend more money to get more people and grow your user base there. If you're able to do this on a regular basis and you can calculate this monthly, you can really see the impact that your product development and your marketing strategy is having on the newer cohort, right? So if we go back to cohort number 3, after affecting your price economic or your unit economics, then you can see that we went from more than 2 years, which is forever in company terms, to just a bit above 1 year. And that's something that we have been using quite a lot to try to set different strategy for the different markets that we operate in. The last measure that we're going to talk about is the LTV divided by CAC ratio. That's maybe not as well known. It's typically a measure that is used for investor to gauge the health of the company. And the way that this is actually working is that if, again, we go back to the example of having a $20 upfront cost for acquiring new users, we have these two cohorts. And I think this is pretty clear for everyone what's going to happen here is that you have one cohort that is much more profitable in this. And what it means is that on the cohort on the right, for every dollar that you put in, you get $3 back. And you can have this virtuous cycle where you don't need external fundings to keep growing your user base, right? Like all the money that you're making out of your sales can be reinvested directly. Whereas in the first cohort, then you're going to need some additional fundings, right? Whether it's from another part of the business or from external investors, then you need something to give you money to get more people to join your product. Yes, so when we are looking at this ratio, what you can see online is that typically this 3-to-1 ratio is something that you can achieve for. And if you're deviating from that, it can send mixed signal. So pretty clearly, if you're below this ratio, then maybe you're growing too aggressively, maybe your pricing is not right, or maybe you're spending too much in marketing. It could mean different things. And on the other hand, if you're thinking that the higher this ratio is, the better it is, well, when I was researching this online, what you can also find is that if you have a ratio of 5-to-1, for example, then that might also mean that you're getting a lot of money, but you're actually not doing your product development as much as you could, right? You're getting all this money, but you're not reinvesting it in growth, and that might also be not the best solution, or not the best situation, I guess. Okay, so that was for the business side. Now a bit about the technical side. So Actually, I changed this slide a little bit yesterday because based on all the conversation that we are having here at Coalesce, the way I was going to talk about this was kind of the old way, how the business did it and how terrible and it was, and how when the data team came in, we made it so much better. But actually, based on the keynote that happened yesterday with Tristan saying, like this one DBT, I kind of rethink about that. And the way now I'm thinking about it is more in phases. So the first phase that we're going to look at here is kind of when we started looking at these measures, the business was driving this, right? They wanted to take a look at these metrics and see where we were at and see how to set the business direction going forward. Now, they could have gone either of two routes, right? Either go talk to the data team, create some tickets, do this priority war, and take forever to get going, or they could go ahead and just do some ad hoc development, get going on their own, and then, try to see if there was an interest in these numbers, see how we could define them, and get going. And this is obviously, from the business side, what you want to do, right? It's kind of like this ad hoc phase where you're trying to see the appetite for something like this. Having said all of this, this was the flow that has been done in the first place, right? So our business stakeholder that was in looking into these numbers was running some self query into Snowflake every month, get a bunch of different exports and different parts and different tools to get your number into a final Excel spreadsheet with some pivots that would end up in some Drive folder somewhere. And while this was great from a proof of value, I think some of the pain points were pretty evident here. So as I just said, it was a manual process. So if we wanted to get this number once a month, then if the person wasn't available, nothing would happen. No one would get this number. So you can forget about any idea of automation, clarity of process, forget about it as well. It was different tools and different layers where all the transformation was happening. Documentation, forget about it, right? The point was not to put it clearly for everyone. It was just to get rolling with those numbers and to get the business to seeing them. Versioning, I won't even mention it. But at the end of the day, what mattered is that we wanted to have this proof of value to see if we wanted to get those numbers looked at and how we would define them. And at the end of the day, that's what was achieved, right? Like we managed to make it work and we managed to get people interested in those numbers. And this is where the data team started to get involved into operationalizing all of these metrics. When we started to get involved, we pretty much had the solution for most of these problems because we're already using Snowflake, DBT, and Looker. Obviously, Looker is our centralized transformation layer, and this is where we could solve all the problems about documentation, versioning, everything, basically. When it comes to clarity of process, instead of having different transformation in different parts with different tools and in different layers, we build a DAG that is understandable by everyone. And this is kind of done in 3 layers. So the first layer, this is something that we already had in place, right? Where I think it's probably true for everyone, where one of the most important models probably or data set that you can have is your sales reporting. And so I won't go into too much detail, but this is where we had everything already in place. Now, the second layer was about creating the different cohorts that we were interested in. I've been saying this word quite a lot now, but cohorts mean a lot of different things to different business. Having this transformation or this model in between here really enabled us to define how we wanted to break down all these metrics that we were interested in looking at. And so for us, at the end of the day, the way that we construct our cohort is based on all the attributes that we're seeing from the first transaction of any user. So what we are typically looking at is which month of the year have you been starting to transact with us, and some of the attributes that are related to the user. So where are you coming from? What product have you first transacted with? And then finally, one of the most important things that we've been looking for the past year, whether you have been subscribing to our product, to any product within the first month or not. But regardless of how you want to define your cohort, having this kind of layer in between kind of allows you to play around and define how many attributes you want to look at here. The final layer is about creating estimates. And it's not something I've talked about so far, but when you're looking at some of these metrics, it's one thing to look at it from a descriptive point of view, but it's quite another to try to estimate and see how you're going to grow from there. If we go back to the PBT example, and you're trying to see how your business is going to grow, you can't really look at the cohort of July this year and go to your board and say, we have to wait 1 year, sorry, to see how much time it's going to take for this particular cohort to offset their acquisition cost. So something that is quite important is to be able to try to do some guesswork into how long we think today's cohort is going to take to offset their acquisition cost. To get into some of the possibilities that you have, or like some of the options that you have to try to estimate, I think we kind of thought about different, like pretty much 3 alternatives, where the first one is kind of to do a simplistic / naive approach, where you try to calculate a month-to-month change. And you can do this in SQL, and so that's kind of what we did in the first place. So here we are looking at like a same cohort, but just with a different initial transaction time, right? So this is the count of users when people started to join us, and then how it looked like over time. So if we're looking at the June cohort, and we are thinking of predicting how many people are going to come back in August, or sorry, in July, so for the second month, what you can do here is that if you take the average of the month of all the cohorts that you have for the second month, and you divide this by the previous month, what that leaves you with is a ratio, right, that is essentially your retention rate on average from the initial month to the second month. And if you do this recursively for all the values, and you multiply this by the previous value that you already have, then you can pretty much guess all of the values that you're looking for here. A different way to get those numbers going is to get some out-of-the-box forecasting solution. So if you're on BigQuery, you have solution. For Snowflake also has some solution. There are probably hundreds of SaaS out there that are proposing to do this. But the only thing that we tried here is to look at the Snowflake forecasting solution. And while it worked, I guess, decently for cohorts that already had a decent amount of data, so cohorts that started maybe last year, what we noted is that if you're looking at cohorts from this year that don't have as many data points, then it's not really looking too bright, right? It's just pretty useless. So yeah, that's something that you can try to play around with, but we were not really satisfied with this. And then the last thing that you can do is also go with full-on machine learning modeling, but we see that takes a lot of time and resource and effort. You need to have probably a machine learning engineer and try to care for and maintain this algorithm. Now, for us, we didn't really care about getting the precise percentage of how many people are going to stick with us, or to the decimal how much LTV we're going to make 1 year from now. What we really only cared about is getting a general direction of where we think those different cohorts are going to evolve. And then having said this, then we decided for now to go on with the naive approach, where we can keep everything into DBT, and we have the DAG. We don't need to have any other layers of Snowflake forecasting or Python. Everything is in SQL. It's understandable. We are using some window function. It's maybe not the easiest SQL, but it's everything in one place, and we know how it works. All right, just to wrap things up here, so I thought about doing kind of a rapid-fire glossary just to kind of print these metrics in everyone's mind. So if we look at retention, this is basically how long are people staying with your business. LTV is how much people are bringing to your business. The acquisition cost is how much does it take to get those people to use your product in the first place. Payback time is how long does it take to offset this initial upfront cost. And the LTV CAC is a ratio that gives you the health or the growth margin of your business. A couple of pointers into the technical estimates that I didn't mention. Something to have in mind, I guess, if you're trying to do this in this naive approach that we have done, is that if you're looking at smaller cohorts, so in this case, we're looking at a tiny cohort that had maybe 10 users. So any variation in, if you're trying to reactivate users, you will have big variation in retention. You go from 20% to 50%, and that's maybe not super representative. So what you might want to do instead is, take a step back. If you're looking at a very specific granular level product subcategory, for example, then maybe you want to take a step back and look at a product category instead and just get more people in your cohorts. Something that goes also kind of in the similar idea is that the further in time you try to predict your data, the fewer data points you're going to have, right? So in the previous example table I was showing you, we only had one cohort that went from month 11 to 12, and this particular cohort, at this time, somehow, we managed to reactivate some of the users, giving us this positive ratio, right? And so if you apply this ratio to all of the newer cohorts, then obviously you're gonna have kind of this smiling curve, right? So it's just something that you're gonna have to think about when you're looking really long term. The last thing I want to highlight here is that exceptional change can affect your current prediction. So due to the nature of our business, we're kind of really impacted by COVID, of course, like everyone else. But for us, it was kind of an upward trend where people were calling a lot more just to check with their loved one, you know, back home and seeing how everyone was doing. So if we were to apply this kind of upward trend to today's data, obviously that would not fly because now the world is not in the same state. And so, you know, you have to bear that in mind if you're doing this kind of blind month-on-month change approach. Just to conclude then on this one, so in terms of the pure process side of things, we estimate that we saved about 1 day of work per month, but something I didn't mention is that this is not anyone's day. The person that was actually doing this on the business side was actually our COO, and so obviously I think all of us can agree that this person's time is probably better spent than just blankly clicking the export tray in Snowflake and then changing the Python file read into some Google Colab thing. And instead, it's probably much better for them to take an actual look in the data and try to define the business strategy for everyone in the business. A good byproduct of this is also that we were able to push this data into Looker, our main reporting tool. So instead of wondering, instead of having everyone wondering if the data is refreshed in this obscure spreadsheet or this obscure drive folder, you know that every first of the month you're going to have your data refreshed, everything is documented and readily available in this one Looker Explorer, and that just made it so much easier for everyone else. On the business side, something that may seem pretty intuitive, I suppose, is that having those numbers and try to compare the different cohorts, specifically between people that did one-off transaction and subscription, on the other hand, we were really able to understand and quantify kind of the improvement that the subscription model had for us. And so for the past year, we've been really trying to grow our product in this direction, whether it's on marketing communication, the way that we try to motivate users up until the first transaction, or all the different features that we have on the product, just trying to get people to subscribe, as we think this is the better way to stay connected with everyone at home. I'm not going to go into detail for the other points, but that's basically it. So thank you for tuning in, and I hope you find this interesting. Thank you. I don't know if we have time for questions. I guess we only have 2 minutes. Yeah. Okay. Oh, yeah.
What do you use to send ad platforms? Do you use like iTouch or something like that?
So this is kind of something that we look forward to do in the future. So at the moment, I think we have some Explore in Looker that is being exported to a spreadsheet, and then this is uploaded by the marketing team to like Google search and whatever. So there is still some manual part to this process, which I did not cover. But this is also something that we're aiming for to automate in the future. Yep, cool. I guess if you have any question, I was going to say you can also grab me in the hallway. But yeah, so we actually did not do like a full-on Python model. Like we didn't want to invest all this time and effort to this. For now, we was just like trying to see how it was working. For Arima, we didn't try because we're not using BigQuery. But when it came to Snowflake, I mean, there's a bunch of documentation online on how you can use or create the forecast that you have. I think what we ended up doing is trying some multi-series. So all the attributes that we have for our cohorts, try to put it as one series, but we didn't really have any features to use to try to like affect those predictions. Cool. All right. Well, if you have any question, I'll be here for the rest of the week, so feel free to grab me in the hallway, even if it's not to talk about triathlon. I'll be more than happy to talk to you. Thank you.